Which of these two stocks do you think is a better investment? Option A is Walgreens Boots Alliance, which currently has a 4.33% dividend yield. And option B is LUMN Technologies, which is paying an 8.57% dividend yield. I'll give you a few seconds now to choose one, and then we can talk about it. Okay, so your answer to this question was likely determined by which of one of these two groups you fall under. If you're a knowledgeable investor, then you're probably thinking that I just asked you a dumb question, since it's impossible to decide which stock is better based off the dividend yield alone. Like, come on, Carson, at least give me the stock fundamentals, business model, stuff like that. And if you're just starting to learn about investing, then you would have likely picked LUMN Technologies, since it's paying out a dividend yield that's almost 2 times higher than what Walgreens Boots Alliance is paying. But unfortunately, there is for the most part no free lunch when it comes to investing. And a stock with a higher dividend yield doesn't mean it's a better investment than another stock with a lower yield. In fact, if a stock's dividend yield is unusually high, it could be what's known as a dividend trap. A dividend trap is a high-yield dividend stock whose payout is simply too good to be true and isn't sustainable in the long term. For many people, it can be really tempting to put all of their money into a company that offers a really high dividend. In a hypothetical scenario, let's say you've just inherited $1 million and you're trying to decide where to park your cash. You might be thinking, well, I could put my money into a Vanguard index fund like VT Sachs, which is paying a 1.46% dividend yield. I've heard good things about Vanguard index funds. But on the other hand, this random stock I don't know anything about, called B&G Foods, is paying a dividend yield of 7.91%. So I'm just going to throw all my money into that stock. That way, I'll get a guaranteed 7.9% on $1 million, which is $79,000 a year in passive income, and I can live off dividends without needing to work a job. But here's the thing, it's not guaranteed. Dividends are never guaranteed. And a company with a ridiculously high dividend yield should set off alarm bells in your head. Behind that high yield usually lies a company with a flawed business model, poor fundamentals, and a management team that doesn't know what to do with their money, besides giving it away to shareholders. They are unable to make the business grow. And if the company has poor fundamentals, the stock price will likely decrease in the future, which shrinks your capital investment. And on top of your capital getting destroyed, at one point or another, the company's management will announce a dividend cut, saying something like,
"Oh, we're looking for financial flexibility. We're going to improve our balance sheet."
Or insert some other excuse CEOs come up with for cutting their unsustainably high dividend. So you might find yourself in a tricky situation. Not long after believing you're going to receive $79,000 in dividends every year from your $1 million investment, you might find that the stock price has since decreased 30%, meaning your $1 million investment is now worth only $700,000, whilst your 7.9% dividend was also cut to 4%. And in this example, you would now only be making $28,000 a year instead of $79,000 a year. And that, my friends, is a dividend trap. And getting caught by a dividend trap like this would probably have you considering getting a job again and moving your remaining $700,000 into something like VT Sachs like you should have done all along. We'll take a more in-depth look at a specific stock today that many people consider a dividend trap. But first, here are some of the main warning signs of a dividend trap that you should recognize in order to avoid investing in one. The first warning sign is a company that has lots of debt. Stocks that carry too much debt are more prone to cutting their dividends during tough times. A good metric to look at is the stock's debt to equity ratio. Generally speaking, an ideal debt to equity ratio will be below 1, but slightly over that can be okay. Debt to equity ratios tend to vary considerably between different industries, so this is most effective when used to compare a stock to others in the same industry. The second warning sign is a company with dividends that exceeds earnings. A payout ratio is a stock's dividend expressed as a percentage of its earnings. For example, if a stock earns $10 per share and pays a $2 dividend, its payout ratio is 20%. A typical payout ratio is usually 50% or less, but of course varies between industries. In any case, a payout ratio above 100% means that a company is actually paying out more than it earns, which is generally unsustainable. For example, B&G Foods, the company with the 7.91% dividend yield that I was using in the example earlier, has a payout ratio of 200%. So B&G Foods is currently paying out twice as much as it's earning, and there is no way they will be able to continue paying out that much in the long term. The third warning sign is an unusually high yield. I know this one is basically what we've been talking about this whole time, but I wanted to go over how you can actually distinguish when a dividend yield is too high or not. Like, is 4% too high? Is 8% too high? Well, it depends. If you're looking at something like a REIT, aka a real estate investment trust, they are required to pay out most of their earnings as dividends, so a 6% dividend yield wouldn't be considered alarming. However, if a tech company that is considered a growth stock announces out of nowhere that it will start paying a 6% dividend yield, then that would for sure be a red flag. What you should do is first establish a baseline to determine if a stock has a high, low, or average dividend yield. You should compare your stock's current dividend yield to what other established companies in the same industry are paying. For example, let's say you're considering investing into a company in the beverage industry. So you take a look at some of the big players in the space, and you see that Coca-Cola currently has a 2.88% dividend yield, and PepsiCo has a 2.81% dividend yield. Then if your company is paying a 3% dividend yield, that would sound about right. But if it's paying a 5% dividend yield, then that might be a cause for concern, and you would need to do some more in-depth research into the stock. So now let's take a look at a stock today that many people consider to be a potential dividend trap, and that is LUMN Technologies. LUMN is a telecommunications stock with a market cap of $11.8 billion, and it currently has the highest dividend yield in the S&P 500 at 8.77%. However, back in January of 2018, LUMN had an even higher dividend yield, believe it or not, at 12.2%. Like I said before, a way we can spot a dividend trap is by comparing the company's financials to established stocks in the same industry. So in this example, I'm going to compare a few key financial metrics of LUMN's against AT&T, which is a solid dividend stock in the same industry that has similar business fundamentals. In January 2018, LUMN had an annual dividend of $2.16 per share, a dividend yield of 12.2%, a debt-to-equity ratio of 1.93, projected earnings for the year of $1.23 per share, and a payout ratio of 176%. At the same time, AT&T had an annual dividend of $2 per share, a dividend yield of 5.3%, a debt-to-equity ratio of 1.31, projected earnings for the year of $3.02 per share, and a payout ratio of 66%. So taking a look at these metrics, you can see that LUMN has a significantly higher debt-to-equity ratio, which means it has a much higher debt burden than AT&T, which should tell you that if LUMN has all this debt to pay back, can it really sustainably keep paying its 12.2% dividend, or will it need to cut its dividend in a move to reallocate that money to paying off its debt burden? Another key point is LUMN has a payout ratio of 176%, which is almost 3 times that of AT&T. So this means that LUMN is paying out more in dividends than it's making in net income, which is of course a massive red flag. And yes, there is a lot more to a company's ability to pay its dividends than just a couple of metrics, but I wanted to show you guys the key measures, which in this case point towards LUMN's dividends not looking safe. And the reason why I was quoting LUMN's 2018 stock data instead of today's data is because now I want to show you what would have happened if you were to have invested in the LUMN Technologies dividend trap back in 2018. What would your investment be looking like today? If you had invested $1 million on the 26th of January 2018 into LUMN Technologies, when the stock was priced at $18.22 a share and had a 12.2% dividend yield, you would have likely been feeling pretty smart because you would have been receiving a nice $122,000 a year in passive dividend income. However, fast forward the clock to the present. Now on the 18th of May 2020, the price of LUMN is sitting at $11.40 a share. So assuming you didn't sell off any of your LUMN stock, that $1 million you invested back in January of 2018 would now be worth only $626,000. So you would have lost 37% of your money in about 3.5 years. But it gets worse, because of course the 12.2% dividend was in fact unsustainable, which meant LUMN had to cut it down, and now it's only sitting at 8.77%, meaning that in 2022, you would only receive $54,900 in annual dividend income, which compared to the $122,000 you were receiving in 2018 is a loss of 55% of your dividend income. So that's why it's important that you can recognize a dividend trap when you see one. Because as this real-life example has shown, a dividend trap can be devastating to your portfolio. And putting all of the financial metrics I mentioned in this video aside, what it really comes down to is that old saying that if it's too good to be true, it probably is. And if all investors lived by that saying, we probably wouldn't have seen the tech stock bubble in the early 2000s, or the housing market crash in 2008. So I think it's a good saying to keep in mind in this weird time of investing, where JPEGs of animals are selling for millions of dollars. But if you want to get started with investing in stocks, then you can use the link in my description to get 6 free stocks with the Webull app. Webull guarantees at least $34 worth of stocks when you sign up, so it's basically free money for you. But thank you so much for watching this one, and make sure to leave a like and subscribe, and I'll see you in the next one. Take care.